Welcome back to my channel. So recently, quite a number of people have been asking me, how did I manage to build a $1 million portfolio so quickly? So one of the key steps back then was being able to identify and select stocks that gave me huge returns. So today I will break that down and share with you my personal journey on that. So step one is to envision what the future will likely be. So back then about 5 or 10, 15, 20 years ago, I envision and foresee that tech will be the future. So back then, right, that 10, 15 years ago, I already can foresee technology being used every day in our life. So at that time, people were already using things like email, MySpace, Friendster, Facebook, Reddit, Tinder, Grindr, and even online shopping. So at that time, I also observed that technology was constantly improving. Back then, they were using what? Fax, phone call, bulky phone, evolved to things like smartphone, email, WhatsApp, or even push mail. So the next step is that I will envision what companies will form this future. So needless to say, of course, I bought technology company because I see that tech is the future. So tech companies will likely be part of it. So back then, what I did was to buy leaders at that point of time. So technology leaders back then were things like Apple, Microsoft, Google, all these things. So why did I buy a few is because I want to acknowledge I cannot predict the future. I don't know which company will do well. So I just buy all those technology companies that were leaders at that point of time. Because the fact that they were leaders at that point of time, most likely they will be able to sustain themselves and continue to survive and be part of the tech future. So I bought them early and then I kept and held the stocks. So one common mistake I want to share with you at that time was I was too engrossed in this PE ratio, price to earning ratio. Meaning for like let's say price to earning ratio is 1 to 10, right? It's something like saying that for every $10 you pay for the company, it only generate about $1 in value. So back then, tech companies were already mostly overvalued. The P ratio was like 15, 20, 25, that kind. So thankfully, I realized my mistake quickly. So to be honest, market and people are not stupid. If a company is good, it will be valued at a higher valuation. People won't go and undervalue it. So I ignore this concept of trying to buy undervalued companies. So thankfully I did that. So I managed to buy all the tech companies, even though at that point of time they were considered overvalued. So the next step is to what I did personally was that I stick to some of my investment principles. So I have this idea is that you cannot predict the future and also you cannot overly diversify. So I get it, it's good to diversify, buy a lot of companies. But honestly, if you're going to buy like 100 technology companies, example, you might as well just buy the ETF like SPY 500 or QQQ, that kind. Because if you buy this type of ETF, you over diversify, right? You will reduce your returns. So if, example, you buy a QQQ or ETF, you might just get market returns like maybe 10% a year. So if you want the higher return like 20, 30 or 40% that kind, right? You will need to pick stocks. And that unfortunately will have to means that you have to take some risk. So concentration in stocks will no doubt increase your risk, but it also helps you to build more wealth. So the best way to do it is to try to mitigate this, is try to buy a few companies in that sector. Example, in the tech company, technology sector, right? I bought a few. I didn't just buy like Apple or Google. I bought a few like Microsoft or even things like Amazon. Even, I want to admit, I even bought Intel and AMD because I cannot predict the future, but they were leaders at that point of time. So even though Intel and AMD didn't do too well, the rest managed to do well. So conclusion is that I want to share with you personally is there will always be winners and losers in the stock market. So you have to acknowledge this rule. You don't always win. But as long as you win more than you lose, you will do fine. So end of the day, a lot of things is about probability. What are your probability of winning and probability of losing? So as long as you know how to mitigate the downside, like personally, I bought a few tech coins so I can mitigate the downside rather than concentrating on just one stock, which is quite risky. So I just want to illustrate with you one quick example is that, so moving forward, right? Example, if you think and you envision fast food will be the future. So who knows, maybe you think that in 10 to 20 years time, people can consume KFC fried chicken or any fast food burger. They eat it and they can fly to space, okay, in 10 to 20 years time. So if you envision that, right, you must start buying those companies now that produce fast food like this type of burgers or fried chicken, like what Pepsi or McDonald's, that kind. You don't wait till like 10, 20 years when that future arrive, then you start buying this company. Too late already. It's like those company announcing good news like AI, new technology, cloud computing, or maybe KFC, McDonald's announce things like, oh, eat my burger and it gives you wings to fly to space. By the time all these news come out, the stock will have ran up like 3, 4, 5 times already. So you don't wait until then you invest. It's too late. So I just want to share with you, this is my personal experience. I'm not saying you must follow me, but I hope that you manage to gain some insight on how investment works, and also let me know what you think or what you envision the future will likely be.